everyone, welcome to another Selloff video on this Tuesday, September 8th. We are continuing the market sell-off that we saw last week with the Nasdaq falling about 7% and today it's down another 3%. And I want to talk about three quick things, which is sort of the shift we're seeing from mean reversion to momentum. The second thing I want to talk about is why kind of markets are selling off in bunches like we're seeing today. And last, I want to talk about maybe the attitude around up days versus down days. So first off, with the shift from mean reversion to momentum, I listened to a very good podcast over the weekend on the Alpha Exchange, where the guest talked about how in 2018, we saw the VIX hit a new all-time low of around 8, VIX being the fear gauge. And for the long part, for a long time, it's been barely above 10. Meaning that, very little volatility in the market, very little fear in the market. The mean reversion being that if the markets opened up 0.5%, they would usually close flat or be down 0.5% the next day. And so there wasn't a whole lot of activity in the markets. In fact, shorting volatility was a very common trade. And for those of you who can remember, I believe it was January of 2018, where the XIV, which was the inverse volatility, it blew up in one day. I think $3 or so billion were wiped out. Investors lost everything in that fund. But now we're seeing momentum, which the guest talked about gamma and options trading. But long story short is if we see the markets open up 1%, they'll close higher. And in fact, even throughout the week, the markets will continue to rise. And days like today, when the market's down, it continues to go down. So just sort of the paradigm shift between mean reversion and momentum, and how investors are trying to cope with this new paradigm shift here. So that's just a very interesting aspect when thinking about the markets, when looking at the markets, when thinking about investment decisions. Are we now in this momentum where are we kind of letting it ride, and the implications around that. So that's just something to consider right now, is how different the trading environment is today than it was just 2 years ago. The second thing I want to talk about is sort of the equities sort of selling off in bunches. Now we know a lot of the times that with the shift from active management now into passive ETFs, that with the basket of stocks, right? People are just selling ETFs blindly. They're not really, I want to reduce exposure, and okay, let me just sell this ETF. They're not looking through each individual name like they might have done in the past and like, okay, let's sell some Salesforce, but let's keep some Activision, let's sell some Amazon, but let's keep some Target. No, it's just now a lot of ETF selling, which is further adding on to the integers we're seeing in sell-offs, and also we're seeing the correlations between stocks now at highs. Which again is great for opportunities because now stocks might be being sold for non-fundamental reasons, but you also have to watch out for because now stocks may be bought for non-fundamental reasons on the way up. But again, something to consider there, which ties into my last point of the attitude versus up days and down days. So my attitude for a long time has been, when the markets were up, I'm opening up my brokerage account, I'm smiling, I'm like, this is fantastic. I might go out and get Chipotle because I was up, a 1% or 2%. When the markets were down, though, I wouldn't check my app. I wouldn't check my phone or my browser. I know I'm down 2% today. I don't want to actually see it, though. I just want to kind of forget about it. I don't want to look at the markets today. Let's focus on something else. And that's generally a good attitude to have for investors who, manage their funds more passively and also have low risk tolerances. That's great because that prevents sort of any irrational decisions of, oh my gosh, I'm down today, sell, when in fact that might be the worst time to do so. But for active managers with higher risk tolerances, I would argue that down days are more important than up days. And in fact, when the markets are red like they are today, that now is when you should really be analyzing the markets. Now when you should be really looking at your portfolio and being like, okay, I have my watch list here of names I want to add. What names are being sold off, as I said to my previous point, what names are being sold off in bunches? What names are being sold off non-related to company fundamentals? And so, again, just the other day I bought DocuSign, I think for that reason, even though I know it's still an expensive name. But there are plenty of names out there that are being sold off, not due to fundamentals, but just due to the ETF selling. and also due to the fact that fund managers, when the markets go down, all right, their risk department might say, hey, we need to reduce some risk in our portfolio. And risk usually is defined as the standard deviation of returns. And again, standard deviation has to do with volatility, variability within the portfolio. So one of the more volatile asset classes is equities. And so again, we kind of saw this in March as well, and every kind of sell-off we see this, in order to reduce risk, they sell off equities. Again, they might not be looking through each individual names, they might just be selling off ETFs or just taking every position down by X%. Long story short is, as retail investors, this is great for us because this is more opportunity we have to find fallen angels, to find names that have been oversold. As retail investors, individual investors, we don't have clients that are haunting us for redemptions. We don't have a benchmark we have to adhere to or a job that's at stake. And we have usually a longer time horizon and therefore probably a higher risk tolerance than most asset managers. So in down days, instead of turning off your computer and looking away, I'd say open up that computer, turn it on, look at your watch list, and start looking at those names that you've wanted to buy and be like, okay, has it reached a point now where I feel comfortable maybe starting a position or adding more to a position, and so on and so forth. So again, these are just 3 quick points I wanted to talk about. The paradigm shift of mean reversion to sort of momentum, why equities sort of sell off in bunches, given that, again, to reduce risk exposure for fund managers, and also the prevalence of ETFs. And then lastly, the attitude towards down days versus up days. And instead of turning a blind eye on those down days, in matter of fact, you should spend more time looking at the markets on those down days and looking for opportunity. Again, how many of us sort of turned a blind eye maybe in March and like, oh, this is too gut-wrenching, I can't take all these losses, I'm just going to look away, when in fact that was a generational buying opportunity. Just 6 months later, many stocks doubled, tripled even in the tech space. So again, opportunity is made during the down days, not the up days. So that's my 2 cents. Again, this is not investment advice. Hopefully you got something out of this. Let me know what you think, and let's make some gains.